Tom Asprey at the MoneyShow.com video network. My special guest today is Larry Williams. Hi, Larry.
Hey, Tom.
Hey, well, you've been trading for 50 some odd years, and I noticed that you've been giving a series of full-day classes on sharing some of the things you've gleaned over those 50 years of trading with new traders. And you know, that's a daunting task. I wonder if you could maybe share with us some of the things that you're trying to get across to the traders to get them on the right path, and maybe some of the takeaway points.
Sure. I think the most significant thing to me in my work is what I'm teaching people now is exactly what I was doing in 1970. So the conditions that cause markets to move are the same. And I think that's really significant. While the markets are different, I don't trade pork bellies anymore because they don't trade anymore. The markets have changed, but it's conditions that move markets. I don't think charts move markets. I think conditions do. And those fundamental conditions are the same now as they were 10 years or 20 or 30 years ago. It's all about conditions, and then bring the technical stuff in on top of when I find a market that's set up to rally or decline.
Larry Williams is perhaps the most famous guru in the futures and commodity market. A much sought-after speaker, he admits he has an unquenchable thirst for the market.
I started trading the stock market, and that's led into the futures, but what really got me into being an investor was saying this looked like something easier to do than working. My father always said, make certain you learn how to work with your head, not your hands, like he did. And I said, use your brains, not your back, and that led to the stock market.
In his lectures and articles, Williams stresses the need for investors to do their homework before they enter the market.
I'm a speculator. The word speculate comes from the Latin specular, like spectacles, to observe. And that's observing and learning, and then you can decide this will go up or that will go down, but it's based on knowledge, not on emotions. Most investors, and especially traders, it's all emotional, buy, sell, and then they don't understand what's going on. As a speculator, I've learned, so I can look and observe and make rational decisions as opposed to irrational, emotional decisions. And that's why I can beat the market, because I'm using my head, not my emotions.
For those who have never considered investing in futures and commodities, Williams has this to say.
I think the easiest thing to do for the average person is knowing that we don't know enough, is to find somebody that knows a lot. One thing I do in my studies is I measure each week how many smart money people, the people that use and produce commodities, how many of those people are buying a commodity. And when a lot of these people are buying a commodity, smart money, big money, and we're talking about the major corporations of the world, General Mills, Cadbury, Hershey's, people of that nature, when they're buying sugar, price of sugar is going to go up. When they're selling sugar, price of sugar is going to go down. So I want to follow what these superpowers of the world are doing. When they're big buyers, I'm going to be a big buyer. Well, I think the average investor is probably really frightened of commodities because they've heard about the risks there, and there are risks there, as there are in stocks. But the real risk comes because they have very low margin, and so they have bets that are way too big for their bankroll. That's where the real risk comes. I think if a person is going to be a trader, you should probably have about 30% of your investment money in trading, enough that it really grabs your attention. If you have just a little bit in there, you won't pay attention to it. It won't mean anything to you. It's got to be meaningful stakes. And if you're just starting, you don't want to put all your money into it because you don't know enough yet. So 25, 30% as a trader, do that until you understand and prove that you're successful.
And it gets to technical analysis versus fundamental analysis, but one thing you just mentioned is the Commitment to Traders report, which a lot of people who trade stocks don't even know about, even though it might be useful. Could you explain the history of that and basically how it works?
Sure. Once a week, the government releases a report that shows what the large institutionals, if you will, or the commercials who buy and sell commodities as well as treasury bonds, their net long position. Are they long? Are they short? How much? It also shows what the small speculators are doing. They're usually wrong. They're very bearish right here. And then the large traders, primarily the managers of commodity funds. And my sense of that, my read of that is without a doubt, we're at an overwhelmingly bullish buy point in here. This is a time to be long, take buy signals, especially trend change signals. We've been coming down, but change the trend in here to the upside in bonds, you got to go long.
And what about other markets such as gold, crude oil? What are you seeing in those right now?
Well, I think gold still has some legs to rally here. Our forecast at the first of the year was for a substantial decline until about August. August has come. We've got a rally in here. I think this rally has legs to it. We can have a pullback in here, but I don't think there'll be much. That on a longer-term basis, we come back in a month, 2 months from now, buying at this general price area will have been attractive.
Well, we were talking about the bond market in the 1980s, and actually in 1987, you did something that was absolutely amazing. You turned $10,000 into, I believe, $1.1 million in a trading competition. Could you talk about that?
Well, that was a trading competition, and I was very young and very aggressive. And I just traded a lot. I did a lot of short-term trading, not much day trading actually, but a hold overnight, a couple, 2 or 3 days, and I just maximized money management. I had a substantial amount of money on every single trade. That's what accounted for the exponential gain. And of course, I had a hot hand in the market. If you get two of those things going together, you can really make a lot of money trading stocks or commodities.
Certainly, and you actually ended up, I think your high water was about $2 million, and you certainly, I read your account of this, you really pressed the pedal to the metal throughout the whole thing, and I think you were away for a period of time doing something else. Interesting, would you like to talk about that?
Yeah, I was in a safari in Africa in the crash of 1987. So the account, I think the account high was 2.3 or 2.4 million, starting with $10,000. And then during the crash, it went down to $750,000. I came back from Africa and traded a $750,000 back to $1.1 million. So it was a little bit of a bounce back in there. But the crash of 87, I felt the pain of that.
Well, you're not the only Williams to have won the competition. Your young daughter, Michelle Williams, at the time also did this. How did you prepare her for that?
Well, I homeschooled Michelle, and so I had to teach the important things. What's a margin call? What's a commission? How to trade? How to drive a car? How to fix a car? And that was just like a task that we did when she was filming Dawson's Creek, kind of a fun father-daughter thing to do. And she started trading and eventually just followed a bond system. She got busy with her own acting career and placed the orders automatically. But the really important thing was she used a money management strategy, X number of contracts or X number of dollars in the account. And that's what gave her the exponential gain that she had in her own trading.
And could you explain for the viewers the difference between technical and fundamental analysis and what you were using at the time, or what you use today, actually?
Well, I use a combination of both. I think you really need to know fundamentals. I don't believe that charts move markets. I think that markets move for fundamental reasons. So the amount of the gain is going to be caused by a fundamental condition. The choppy or erratic stuff along the way, that's caused by price action and emotions. So the technical stuff looks at price action, whereas the fundamentals look at supply, demand, relationships. And I really like to combine both of those together. I think that's the optimal way to trade. You can't have one or just the other. I think you need both of them.
For 2015.
Exactly. 2014 is a setup as I see it. 2015 is going to be a rip-roaring big bull market.
Okay.
Just as was 2005 was, as 1995 was, as 1965 was. In 2015, you want to buy all the big breaks in the market, never sell the rallies, because we're going to be in a big upturn like we saw in 2003.
Okay.
That's, I think, the program for 2015. It starts, though, in the fall of this year. The 4-year cycle turns up, yield curves turn up. There's a great buy point coming.